markets evolve and we see changes in technology, new efficiencies in execution and automation, we see the introduction of new investment products, and the cost to trade over the years has obviously radically been reduced. And as we ask how best to compete with the institutional world and cultivate our edge and aim for consistency, who better to explore the evolving world than Linda Raschke? Linda's been trading since the early 1980s. She started in the pits as an equity options market maker. She's held various roles as head of trading for various hedge funds. Her best record was being 17th out of 4,500 for best 5-year performance in BarclaysHedge index. She was an original markets wizard. She's written a number of great books, including Trading Sardines. And it's my privilege to explore her process, her framework, and her amazing mind. So without further ado, let's get to it. Welcome to the program, Linda. How are you going this morning?
Thank you. Thank you for having me on.
It's a pleasure. Now, I talked about that in the synopsis there about, you cutting your craft in the pits, in the trading pits in San Francisco in the early 1980s. Now, I remember my first day on the trading floors of big sell-side US investment bank, 1998, walking onto those pits, onto the floors, and just being absolutely blown away. But, the trading pits, the open outcry would have been a whole different situation altogether. So going back into that world, I mean, how, firstly, I'll sort of phrase it on a two-pronged question. First of all, how did that shape, your character as a trader, your resilience and your determination? And secondly, how did it evolve your framework and process? And have you taken that forward going forward?
When I was in the option pit, it was very different from what people visualize as being open outcry in the futures markets, like S&Ps and bonds. And so it was a little bit more of a strategic arbitrage game. Now, we definitely had our active and volatile periods, because in the 80s, that's when we had Michael Milken and greenmail and blackmail and, the share of takeovers and random things. But really the options were a new frontier in the late 70s, and pretty much, I would say, by 1985, 86, the edge that initially was there in terms of the mispricing had been arbed out. So in the very early days, you could, exploit that edge for more of a profitable thing without having to worry about directional bias. And now the options, because there's really no edge in terms of things being mispriced, unless you're going to debate on what the implied level should be or the volatility, then, it's going to be more strategic in terms of safer ways to position with a long side bias, or safer ways to position with a short side bias, or if you want to try and see if you can capture the middle of the thing, so forth. So they're just a different way now of expressing, in my opinion, a directional bias, but there's no real edge to the individual strategies anymore.
Yeah, cool. But you would have been there on the floors with some incredible individuals. And how much, we talk about your framework and process then. I mean, how much of what you have today did you start off, and learn from that process back in the 80s?
The person that backed me, when I first went down onto the floor, was very methodical in terms of doing the homework every day. In those days, we had a silent, Texas Instrument 700, which we dial up and put in all our positions at night, so that we could get the plot of things and print out what the, fair value would be for the next day. So it involved a lot of input at night, when the markets weren't trading. So you just sort of got used to doing that as part of your regular routine, either updating numbers, updating your charts by hand. It was every trader I know that was doing a little bit more sophisticated or intensive type of positioning, as opposed to just flipping paper. You really had to put in at least an hour every night. And even now, with the computerization, the homework and stuff really hasn't shortened, in terms of preparing for the next day.
Cool. We can talk about how you go about modeling probabilities and various factors further on. But I think one of the things that I've noticed in listening to some of your work over the years is your humbleness. And you sort of extenuate some of the losses, and you talk quite openly about some of the losses, which is obviously a very refreshing situation for someone in your position. I mean, I think being humble is something that traders have to be. But I think there was one loss in particular that you talk about, where you were selling volatility, selling straddles over a potential takeover, and that hurt you. And I think you learned some big lessons. So you want to talk us through a little bit about that situation and ultimately how that's shaped your vision about taking losses going forward?
Well, I think taking losses is going to just be a certain temperament thing in terms of how risk adverse are you? If you're too risk adverse, you're not going to make it as a trader. But on the other hand, you need to just respect risk as well. So with regards, because some people just aren't comfortable losing, and you're not going to be happy in this business because it's like sports. If you look at basketball or baseball or football and you look at the stats, or tennis, right? 50, one person's going to make 50% of the points. The other person's going to make 50% of the points, or that type of thing. So, trading's no different. It's just about a big giant numbers game, and you have to look at a broad universe of numbers in order for a very small statistical edge to play out. So it's not an ego thing about being right on the trade. You have to have a strategy that you could do 100 times and say, if I do this 100 times consistently, 60% of the time, it'll be XYZ and have this shape. So with regards to my first early loss, it was really miserable. I don't know. It was a very unhappy period in my life, just because I felt like now I am a slave to the business. There was no other way for me to go and do anything because I owed so much money, so I had to stay in the business to make that money back. And I was fortunate in that I found another backer that I could be their little grunt gopher, and slowly pay off my debts for 5 years. So with regards to that, I guess you could say that it kept me in the game the hard way. And ultimately, I think to make it in this business, it's a matter of gaining experience. It's not how much you study, how many books you read, how many courses you do. It just takes a lot longer than people realize to get all that experience, to see bull markets, bear markets, volatility, dead markets, all these different types of arenas, so that you can begin to put things into context. And you can't learn to put things into context just from studying charts and modeling strategies. It's all the little subtle nuances. So again, I love the analogies with sports. You could read about tennis, you could read about golf, you could take lessons in the strokes, but it's until you're out there playing on different surfaces, playing on different courts in all sorts of different type of weather conditions and all sorts of different mental conditions, that you really need, that decade of experience before you can just start to say, okay, now I've arrived in a little bit more definitive way.
It's interesting then, because you say that, and with you having traded since the 80s and you've gone through these different cycles, the word instinct, did you feel a certain instinct about something that's happening, or do you think that there's no way that you can have that instinct about market, that you're kind of anticipating what's going on? The market will just do what it does and those factors. But do you feel like over these decades you have an instinct about what's going to happen?
Instinct is a really nebulous word. It's very subjective. So I don't like that because people misinterpret it a lot. I would suggest that, more reading the tape and the tone and the color of the market and understanding the variations that can play out, that I could say, oh, okay, I've seen this, for example, today, that price rejection at the top, and then when it takes out the low of that report bar, that's not necessarily instinct, but instinct could also be defined as the sum of your experiences that then bubble up into your consciousness. So I think it's a word that would get people into trouble because they might be right one time and they might think, my instinct was right. But, that's a really crappy way to think that you're going to make a living.
Yeah, sure. I want to go back. You touched it on the prior question, but you were an options market maker, and I think one of the great things about options for me is that they make you think that they're based on maths. They're quantifiable. Effectively, you're sort of made to think in the distribution of outcomes effectively. But when you're trading S&P futures, when you're trading markets like that, do you think in terms of those balance of risks and probabilities, and how much did the sort of options world shape those views in terms of assessing the likelihood or the probability of distribution of something going in a certain direction?
No, I don't look at that at all with the options. And I think that if you had never had the experience with the options, you still think in terms of probability if you're apt at game theory. Okay. Yeah. So people that have an affinity towards poker, blackjack, cards, or, other types of games may never have any experience with the options, but some people are more comfortable in that arena of the fuzzy variables and, game theory and all these types of things. So the options, there's room there for somebody that wants to utilize that as a model, statistical model. But again, my experience with options was originally much more arbitrage oriented.
Yeah. Okay,
so you just learn that if you do this, enough times with arbitrage, and then you also learn more often than not the hard way that when it seems like there's an arbitrage opportunity that something should converge a certain way and it's not. Yeah. That's the market giving you very important information. And, we would like to think in terms of these hard and fast linear models, but it's more important to recognize that when an arbitrage type of thing is not working and that convergence is not happening, then you better really be quick to manage your risk and maybe perhaps reverse things to capitalize on that. So that's a better way of thinking.
Yeah. Okay. I'm interested. Are you an avid poker player or blackjack player? Are you regularly taking annual trips to Vegas these days?
I hate poker. No, I hate gambling. But we grew up playing cards. I like bridge, gin rummy, hearts, that kind of stuff. So I like games where I feel like I'm more confident to win, and poker's just a little bit too much chance. And I don't like to try and read other people. I'm not very good at that.
Okay. I want to talk to you about changes, like the biggest change for you over the years since the 1980s. We're probably a bit closer towards home, but we've seen major changes in technology, the way that we can execute trades, automation. I'm not sure if you run an automated model at all. Obviously, we've seen much lower cost to trades, the ability for the everyday trader to be involved in different markets. There's just so many different advancements across the whole suite of trading. But for you, say, let's take a time frame, 5-10 years. What's been the biggest change that you've seen which has affected your trading?
Well, I think the costs have gone down to a point like as of 10 years ago. I don't think costs have dropped any lower than really they did 10 years ago. If anything, the data fees have jumped up,
Yeah.
So I can rule that out. The hardware or the computers, the CPUs, if you had a machine that was 8 years old, that's fine, honestly, for most people's purposes. I would just say maybe slight improvements still in software that you use, be it charting software. Maybe it's become a little bit more robust. The crashes don't happen the way that they used to. The latency issues don't happen the way they used to. The exchanges have learned how to manage the amount of data now that comes down the pipeline as opposed to 20 years ago. So I can't say that there's been anything real earth-shattering, at least in my universe, the last 5 years.
Okay, it's an interesting one. Last question before we go into your process, your current process. But I hear this situation all the time that the institutional world is moving, and the technology and the high frequency trading and the sort of candidates they're getting in from the Ivy League universities means that they're evolving at this kind of exponential pace. But private traders, sophisticated traders, retail traders effectively are sort of moving at a sort of much more glacial pace, and that means that they're struggling with to compete in that world. How do you stack up in that argument? I mean, obviously, you trade at home now. You have traded in the hedge fund industry. But, do you poo-poo this argument that we really just can't compete with the institutional traders and we need to adapt?
They're not nimble. They can't trade on short time frames unless, of course, you have a Medallion Renaissance fund or some of the ones that are, just... And even then, the holding time for some of these billion-dollar funds with these amazing records is just 2 or 3 hours, but it's just high-frequency trading. It's something that's not going to take away from you or me. We need the liquidity that some of these high-frequency algorithms provide. It's hell to trade without them. My husband, his partner was one of the founders of Gecko, which was one of the original market making high frequency, buy on bid, sell on offer type of thing, which became a very crowded field. And that edge went away in about 7 or 8 years. It got arbed out. See, so you don't make these blind assumptions that I'm competing against the institution. I could have a one lot, and it's just going to depend on where do I get in and where do I get out. You're making the assumption that it's a zero-sum game. And it's not, because you have so many different time frames working. So I'm grateful that there's the institutions, because there's always a bid to hit them, There's always an offer to take.
And they're always so constrained as well in so many of those funds, which is their disadvantage as well. Now, I want to talk to you about what you're doing, your process now, because throughout this year we've seen generally pretty high volatility across multi-asset classes, certainly in the rates and the bonds market. I'm not sure if you trade much of those, but obviously liquidity has been a factor there. But I want to talk to you about the current trading environment that we're seeing and how you're cutting your edge or adapting in that situation. Now, I talk about volatility a lot. I know you talk about a lot of volatility, whether we're talking about realized volatility and measures of realized volatility, or whether we're looking at implied levels of volatility and optionality and understanding what the market's expecting by that. But in terms of, the changes that you see in volatility, things like ATR and various factors, how does volatility shape your strategies, your position sizing? How much credence do you put in volatility?
So I define volatility, because you're right, there's lots of different ways that you can define it: percentage, standard deviation, all this type of stuff. I'll just use the standard default of average true range, and then I'll express that by the dollar amount per day. So I'll look at the dollar range per day of, say, the bonds, or the dollar range per day of the crude oil, the dollar range per day of the grains, and then that will determine my unit size. So let's say the average true range is $2,500, per day. Well, I might only do one contract per $50,000 of the $2,500 range. And let's say in the good old days when corn was, $400 range, well, then I could trade 5 times as many corn contracts. So it determines my position sizing. And the nice thing is that by recalculating this once a quarter, it's just this dynamic, thing that it's never changing my decision-making process. It's a unit size, you see? So I'm always expressing my bets in terms of a unit size, and I try to keep that constant. And in terms of the volatility, God bless it. We need that, to provide opportunity. There's nothing worse than trying to trade in a bear market where everything just flatlines like the patient died. It's a horrible feeling. We had that in the early 90s. Yeah.
If you're seeing average range pick up, obviously the volatility, the range expansions there, will you take when you're looking at the number of periods that you're using in that average true range? Some people use 10, some people use 5. Will you make that shorter to give it more credence to what in terms of the range you're seeing now? How do you measure the amount of average true bars or periods that you're going to use in the average true range depending on the volatility?
Well, I'm just looking at the daily range. So I'll take the 24-hour, the daily
24, yeah.
bar, for the S&Ps, right? So I'm not using the pit session. I'm using the 24-hour session, and then I'll look at the range of the S&Ps on a 10-day moving average, and yeah.
Okay, perfect. You run different types of strategies. Talk to us about that. I want to talk about your day trading strategies specifically in this situation. Environment, I call it environment recognition. I think a lot of people call it environment recognition. Understanding, if we're in an imbalanced market, a trending market, choppy sideways trading market, and obviously deploying momentum strategies or mean reverting strategies. Using things like market profile, VWAP, but I think this idea of understanding the environment which you're trading in for the day. How do you go about assessing that and deploying different strategies? What does Linda Raschke look at?
Well, for most of the markets, I'm not going to make more than one trade a day in it. I'm just trying to capture a piece of the trend for the day, and ideally in a perfect world, like for example the S&Ps, it's a trend day up or it's a balancing day, and maybe if it's a balancing day there might be opportunity for 2 or 3 trades. I don't know, this notion about day trading, to me, just means not taking things home overnight, but it doesn't mean that you're having this high frequency of activity, because that's where people start to get into trouble. They think that they can trade on the noise, and that's very tricky to do. Because you'll start off and you'll have 2 or 3 great trades and feel good about it. And then, as the day goes on, you're tired, your decision-making process starts to drop off, and you'll end up giving back some of your morning profits, is typically what happens. So it's not day trading in the sense that you would have been in the pits, 40 years ago on the trading floor. So that's my personal take. I just think it's trying to sit there and, let's say you have a universe of 300 stocks. Sure, we can day trade. We can make little scalps, look for the little small flags or continuation patterns on the strong momentum ones. But the problem with that game, first of all, it's hard. It's not a very scalable game. It's fine for a retail size account. It's very difficult to do if you've got, like, you want to have a fund of $100 million or something. And the second problem is, it's very difficult to do for 30 years. So what we're really looking for is establishing a way of operating in the market that's not dependent on you, being 27 years old and having all this ridiculous amount of energy and attention and focus. I mean, what if you've got kids and a family and this and that? Is it going to be a viable way to operate? And it's very difficult then to maintain a consistent strategy, a consistent statistical edge type of approach. So I really try and think of, what is the play for the day? Is it going to be a high to low day? Is it going to be a low to high day? Is it, did we just have a big range expansion day where it is going to be a little mean reverting in the morning as the market's trying to come into balance? Or let's say we've just had 2 or 3 days and you've got that nice balancing and we're ready to move out of that. So it really is simple if you just look at it in that type of context.
So what are you doing to identify that? Is it just pure price action that you're looking at in terms of understanding those high to low days and various factors? Do you use market profile, VWAP?
I don't use market profile, but I think that's a very useful tool for understanding concepts, how the market's gravitating towards a central value, or it needs to go back and fill in places where it just went up too far too fast. My husband is fabulous at that. He's been in the markets for 45 years, Damon. But so that he's very comfortable using that. And it's just really not in my wheelhouse. You have to sort of pick your tools and then stick with that. You can't add too many things into the pot, the ingredients, because then it just gets a little muddy there. So I'm more of a pure, when I say momentum, people think of the increase in momentum such as breakouts from charts, but I'd like to think of it more as a directional oscillator. So the loss of momentum or the increase of momentum, and putting that into context and using a slightly higher time frame, because, you're going to just get chewed up on 5 and 15 minute charts. So
Would you use
You
moving
know,
averages in defining that move up, or would you know, rate of change, or how would you measure that momentum?
Um, well, I've always used a 2-period rate of change, and I've put out so many videos on that, and it's just a slightly better signal to noise ratio than a 1-period rate of change, and it's just worked for me. So plotting that by hand is a way of sort of, a Bayesian approach, just one piece of data at a time. And I don't know, over time, it's just, I think that's the edge that experience gives you. We just sort of build up like a little artificial intelligence machine, always doing that learning process, right? And again, putting it into context, is it a channeling market, or are we in a broader consolidation trading range? These little types of clues, and we never know for sure. That's what you got to understand. Nobody knows 100%, but I'm going to look to sell above previous highs, and I'm going to look to buy below previous lows, or cover shorts around previous lows. So kind of classic stuff.
Yeah. You said that you tend to only hold one position at a time. Is there a reason for that? Is it just to try and keep life simple?
I never said I hold one position at a time. I might just make one trade for the day at a time. Yeah. So if I've come in, like I came in long the gold and the silver and the copper this morning because I had bought them not like the evening before, not yesterday. I held them all yesterday, but the evening before it was set up for just a little, swing up because we had 2 days down. So I held yesterday and then I sold them out today. So it's sort of that was the play, capturing, the 1 day up and a little bit more follow through for me is the rhythm that I feel most confident with, and every time you want to push something a little bit further and longer duration, what you'll find is that's okay to try for that, but your win-loss ratio is going to go down. So you need to be a little bit clearer about, okay, I'm playing for this turn up on the weekly chart. So for example, a couple weeks ago, if you looked at the daily and weekly charts, the weekly oscillator is pretty oversold. And so you will have about 3 times a year on a market where that weeklies might be the dominant technical, and you can get a string of maybe 8 or 10 days, but you just don't get them as often as you would think. And so you really need to go back and study this concept of frequency of occurrence, okay. Sort of like a reality check. And, everybody wants to play for like hitting it out of the ballpark, but the frequency of occurrence on those types of setups is much more remote. So, yeah.
I think that's a really interesting point. And we talked earlier about modeling and talked about probabilities and various factors. But I'll take you an example. We've just seen dollar yen up for 12 days consecutively. Obviously, we're going through regime changing markets, and these kind of trends do happen when you get these widening of bond spreads and various factors that are taking place. But when you're looking at something like a propensity for ongoing movement, how do you use modeling to say, well, this has happened this amount of times, the next day it's done this sort of stuff? You might not do that at all, but how do you go about looking at predictable price patterns or price patterns and using that information quantitatively to potentially portray into the next trading session?
So take something like the yen. Let's say, for example, that it hits that point, that threshold where it's had 6 consecutive days of higher closes on one side of a short-term moving average, or 7. Yeah. Okay, there's like a little sweet spot there. So once it hits that 7 number, now it's about a 50-50 bet that it's going to continue, okay?
Yeah.
So if it continues, it's what I call an extended run, this persistency of trend, and it can go anywhere for 2 more days to 18 more days in that direction. It can go for 27 consecutive days on one side of a short-term moving average. Is it going to do that? Maybe it's going to only do that a very small percentage of the time, but I know not to try and make a counter trend trade. And if I do have a position on, then I'm going to trail a stop because it could be an outlier type of run. And the markets tend to have these runs. Each individual market can have these runs of at least 7 consecutive kind of closes about 10 times a year. Now, with half of those, they might start to come into balance and then revert back down. So now you see about 5 of those times, it can really extend and be a trendy type of move. And so you really have to look into the numbers and examine past occurrences and what they look like. And so this is all part of the learning, you see. And I've just learned the hard way, of course, that these things always go further than we think. But so now I know once we hit that magic little 7 point, because I've done the modeling on it, I can say, N number of times over the last 30 years, we have gone to at least 24 closes on one side. So now I've opened my mind to those possibilities, because the problem is, especially for people that are newer in the markets, is they don't have that database, of to draw on, because the frequency of occurrence is relatively low. And
are you doing that? Are you doing that like just by looking at past behaviors, or are you writing code in Python using Python, for example? And
I don't even know how to use Python. Sorry, did all my modeling off of TradeStation, but you could do it in Excel. It's really not any sophisticated thing. It's I had a guy that did all this for me with the TradeStation, and for my purposes, it served just fine. Yeah.
I talk about these changes in volatility, and I want to understand how you see leverage in that situation. So, we have different asset classes which have different degrees of leverage and offer different degrees of leverage. I mean, we offer CFDs, and you can change your leverage settings. But how do you consider leverage ratios and the leverage you've got in a product, given the volatility and the range expansion and contraction in markets?
Well, back to, my primary vehicle is the futures markets. Okay. So, that's where I'm using the average dollar range to, determine my bet size. Do I want to do, one contract per 50,000? Do I want to do, one contract per 200,000? Do I want to do one contract per 10,000? That type of unit sizing. And then just because you have a unit size, let's say, when I was managing my fund, let's say I'm doing 4 contracts per $1 million, well, it doesn't mean that I have to use my full unit size. Maybe I want to use a half unit size just because we're in a more mediocre type of environment. Or I could even say, I have a full unit on, and maybe I want a second unit, just to scalp in the direction of the trend. So there's all kinds of ways that you can play with this. But if you reduce it down to a mathematical formula, you see, you've taken away one of the decision-making things that tends to clutter people's brains. And what they'll do is they'll bet bigger on trades that maybe they think will work, but they don't. And then the trades that do work, they didn't bet, enough on because they couldn't see it working. See, so we don't know what's going to work or what's not going to work. So for me, it's really important to keep a very even bet size. It's like trend followers. Some of the best, I've heard them say that they don't know where the next big win is going to come, and if you tried to guess that, you're going to get it wrong. And that's what makes a really big trade, is the fact that nobody can see it coming. You see? Yeah. So you have to keep a very consistent type of game theory in the background.
Yeah, I just trend followers. Obviously, having a range of multiple products is obviously very advantageous, because you don't know when that trend's going to come from. You're hunting for those outlier trades on the distribution, where it's going to be. So that's why having a big product range means you get to capture those trends. But what for me is one of the interesting things is the characteristics of each market, and each instrument, each product that you trade. From a liquidity perspective, from a cost perspective, the way that it's sort of propensity for trending and all those factors. But when you're choosing an instrument to trade on one day, S&P futures, it could be an agricultural commodity, how do you think about the sort of the characteristics of movement, the characteristics of costs and stuff, or do you just don't, it doesn't really matter, it's just the price will do what it's doing?
Doesn't really matter. I'm just going, where is that little setup that I like, that little sweet spot that I like, and then whatever market, it falls on, that's where I'm going to play. And sometimes I miss a lot of trades. I can do my homework and have great setups in 12 different markets, but I know I don't like having more than 6 positions on. So some you're like, geez, I missed that great wheat move. I just missed, there was like some fabulous wheat volatility just in the last 3 days. My models were like spot on 100% with that, but I didn't do it because I was involved in other things, and that's okay. You can't do it all, but if you try to do too much, at least for me, that's where I get into trouble, unless I have an assistant or a sidekick to help, or you set on some automated trail stops, then that can be helpful.
Yeah. Last question, which I think is a really, really, really important one, is this idea, especially when you're learning to trade, of what we call continuous improvement, documentation of your trades, and then actually spending time to review, what you did well. You do more of what works, you do less of what doesn't work, these factors. And, new traders, learning traders, should obviously attempt to do this. I mean, is this something that you still do rigorously? How do you go about, understanding where your edge is, or reviewing your edge and maintaining that edge? How do you go about continuous improvement?
Honestly, I haven't done anything for 30 years, so
okay.
But in the beginning, I think. And that's Brett Steenberger's type of spiel, do more of what works, do less of what doesn't work type of thing. But you'll find there's some real common denominators. Most people will have more losing trades in the afternoon just because your alertness and decision-making ability starts to go down. The best opportunities are in the morning, So what tends to happen is people either get cognitive biases, or B, they lose a little bit of self-control with overtrading, which is really easy to do with a mouse, so you have to be aware of the the stimulus that comes from that. And so I think I never really went back and reviewed my trades, but I would go back and print off the charts at the end of the day, and then by deductive logic, circle what the turning points looked like, so that I could, understand to be right on top of those. And it's very hard to, we don't want to be too critical of our trades if you're newer, because sometimes our reason for exiting a trade usually is going to come from a more emotional, mental temperament type of thing. It's like the uncertainty starts to creep in, so we exit. Don't beat yourself up on that. You have to say, I'm using my best judgment at the time, and you have to make it okay, to exit. Yes, of course, the model said stay long and trail the stop type of thing. But then what happens is that people get all caught up in this self-talk and these little loops and this negative, I shouldn't have done this, I should have done that, all that kind of talk. And that's very counterproductive. So I'd rather see people, print off charts or review where the choice opportunities were and what they look like, because I really believe that everybody knows damn well what they're doing wrong. You shouldn't have rebought or, gotten tripped up in that type of stuff. I mean, So I think it's more of a temperament issue, just it's okay. When we start off trading in the pits, right? What do people do? Oh, I bought an option and I sold it for 10 cents higher. Woohoo, one lot. And then, add that up to your bottom line. And, it's not like you're going to go out there and slay it, buying the lows and selling the highs. So it has to be more of this cumulative process. And how do we keep ourselves operating, in a relaxed environment, not getting overly anxious, but yet still having some intensity and focus. And, also understanding that you can't really keep up that type of intensity and focus for more than 90 minutes. And so, just be really clear. Your entries are most likely to come at the start of the session, be it start of Asia, start of Europe, start of US session, meaning the morning sessions for those time zones. And of course, there's always like today's an exceptional day, FOMC, everybody would understand that,
Yeah.
you know.
Yeah. Well, Linda,
these performance-oriented things, there's so many really reasonably priced books on sports performance, sports psychology. And I think that if you just read those, I find them, that was my inspiration all these years. I'm always reading all the performance and sports psychology for like tennis or baseball or any other thing. And they're like $10, you know, you don't need to spend a lot of money on that stuff.
Yeah, good advice, good advice. Well, Linda, it's been fabulous talking to you. You're an original market wizard, so we're humbled that you could spend this time giving us some of your views on trading, some of the things that you've learned through evolving markets and various market regimes. So from everyone at Pepperstone, for all the clients watching today, we thank you from the bottom of our hearts. It's been a truly great experience, so thank you very much.
Thank you, Chris.
Cheers, Linda.
Bye.